Thank you for joining LinkedIn to discuss the next generation customer journey in wealth management. My name is Manika Tiliamplam. I'm the head of North America Financial Services Marketing at LinkedIn. By 2020, there will be Millennials and Generation X who will have $30 trillion in investable assets. Millennials' different attitudes towards wealth and how their experiences and their expectations of customer experience are demanding changes within the wealth management space. Other disruptive forces within the industry also include FinTechs challenging incumbents, and we also have robo-advisors providing opportunities for asset allocation. So in April of 2016, LinkedIn collaborated with Greenwich Associates to survey 469 high net worth individuals across 4 countries, including the United States, United Kingdom, France, and the Netherlands. And today we're going to be focusing on the research findings from the United States. And the objective of this study was to really help wealth managers really understand how they can attract and retain high net worth individuals across the next generation customer journey in wealth management. The sample population included 4 generations. Millennials, defined as between the ages of 25 to 39. We have Generation X between the ages of 40 to 51. Baby boomers between the ages of 52 to 69. And finally, 70-plus-year-olds. In the United States, and for the purposes of this study today, we've defined high net worth individuals as having $1 million in investable assets, excluding real estate. This morning, you should have, or you will be receiving an email from me that provides you with access to this research study, Next Generation Customer Journey in Wealth Management, High Tech or High Touch. So please look out for that. Also, following this release of the research study, next Tuesday, you will receive a follow-up email from me with the release of Reimagining the Next Generation Customer Journey in Wealth Management. And now this is an illustration of what we at LinkedIn believe to be the idealized next generation customer journey in wealth management. And this illustration was created from a triangulation of our insights that we got from our study with Greenwich Associates, and it also included insights and information from studies from Capgemini, PwC, McKinsey, and Forrester. And then we overlaid that with interviews from CEOs and senior level executives from wealth management firms and also from robo-advisory. This illustration, we believe, is quite unique in the sense that it is the first of its kind within the wealth management industry to really bring to life what we believe the next generation wealth management customer journey will be. So please look out for that next Tuesday. So before we jump into the panel discussion, I also wanted to welcome you guys to view the gallery downstairs at the conclusion of this panel. So without further ado, we're going to be focusing on the 5 stages within the customer journey, which you'll find right behind me. And the 5 stages that we're going to be focusing on are: first is awareness, followed by consideration and selection, and then onboarding and action planning, and then network development and keeping the relationship alive. To help us with this discussion, we have a great lineup of panelists with us today. Our moderator is Wang Fang Zhu, Customer Success Executive at Hearsay Social. We also have Cameron Rayaz, Managing Director and COO of Future Advisor. We have Michael Goodman, Founder and CEO of WealthStream Advisors. Dan Canal, Managing Director from Greenwich Associates. And Jonathan Stein, Founder and CEO of Betterment.
All right, great. Thanks everyone for joining us. We'd like to kick it off by starting with the first part of the customer journey, awareness. So from the study noted that more than half of high net worth individuals actually have one or more wealth manager. Do you think, for the panel, do you think it is hard to raise awareness of your services amongst prospects?
I'm happy to
Go
start.
ahead, jump in.
So first, excited to be here and really loved the study that you guys put together. I thought the Greenwich and LinkedIn survey was really good. Sending it out to my whole team because we're also doing a lot of work on thinking about this customer journey, and it's really interesting stuff. I think awareness for Betterment, we're an automated investing service, and we don't have any trouble with awareness. I mean, we're the largest, the fastest growing in the U.S. People know about us. I think where we probably struggle is in people understanding everything that we do for them. So people will come to the site and read about what's there, and maybe they read an article or something, but there's so much richness to the offering that I think only a fraction of our customers actually know about. And as we think about the customer journey, it's how do we engage people at the beginning in a way that they understand that we're solving their specific problem, and then throughout their experience with us, tell them more and more and reveal more and more about all the things that we do. So for instance, we do account aggregation for people. I think probably only 10% of our customers know that. I mean, and nobody who's coming to this site knows that we do this. Like, we'll replace mint.com for you. It's just like one example of many services that we offer that I don't think most people are aware of. And I'm sure many advisors have a similar challenge of explaining what they do for people.
I can jump in on that. So I think so I'm Cameron Rezai from Future Advisor. Thank you, LinkedIn, for having us here. We have not that much of an awareness challenge for a slightly different reason. Our business strategy is to take robo-advice and really white label it to large wealth management firms, financial institutions that are serving their end customers. And so we're in the business of really working with branded, established wealth management firms. So from our perspective, what we see with them is a lot of wealth management firms have spent time over the years kind of building up their brands, significant marketing budgets, huge forces of advisors out in the field. And so awareness is a challenge they have, but they're looking to say, how can I engage that client and really kind of drive conversion more? So, in the market of delivering this in a B2B space, there are a handful of players, and so, as the industry grows, we see a lot of wealth managers looking to partner with firms like ours, and they want to take that awareness, all that sort of brand equity and that advisor, reach in the marketplace and convert it to something, and that's kind of where we've seen the greatest opportunity.
And then, I'll approach it from a bit of a different angle, which is more the research angle. So I'm from Greenwich Associates, Dan Cornell, and we look at the awareness of the whole wealth manager rather than individual portions of it. And in the research, some of the things that we found were pretty interesting in that awareness of the wealth manager and their offering, far and away across all of the different categories, was based on personal relationship. A family member made a recommendation, a friend made a recommendation, those kind of things, and far and away across all categories, that's where the awareness came from. So in the market, networking is really, really important. However, when you break it down into the different categories and looked at the sort of the next level after, if that's table stakes, what's the next level of awareness and what drives awareness there? Millennials seem to be a little different from, say, the 70s and older, right? The 70s and older, much more attuned to the brand that's being put forward, which means advertising, newspaper, traditional media. Millennials, on the other hand, much more geared towards social, right? Makes sense, but if you're looking to drive awareness and you're looking for a specific category, then you need to look at different means of generating that awareness, and there are different forms of media that clearly came out in the research as being more important to one category versus another. And you'll see that in the things that Menica sends across.
My name is Michael Goodman. I'm with Wellstream Advisors, and thank you, LinkedIn, for having us here today. And it's an honor to be here with you all, so it's wonderful. Being the individual who represents a firm who's been around for 20 years now, doing wealth management, almost akin to what you might view an accounting firm or a law firm like. We are invested with clients at the table doing wealth management and financial planning. So our awareness is sort of a little different in the sense that our brand exists, but it's on a micro level, comparatively speaking. our business is really coming mostly through, as you mentioned earlier, that network. I'd say about roughly a half, let's just say, come from people saying, I need somebody to help me with that, and somebody knowing us. And then the other half is through COIs, or centers of influence, other attorneys, accountants, et cetera, that are recognizing that these clients are having these problems. So a little bit different angle for us, but it is still important to make sure that we have that awareness out there and educating our COIs and our clients, all of our services, as you mentioned. Some of our existing clients might not know. We told them, of course, what we do, but sometimes there's just a lot of information, so you have to make sure you're continuously marketing. We were talking recently about onboarding clients. The onboarding process probably never really stops. You're constantly onboarding clients to existing services as well as new services you might be developing.
And what we also found out from our research study as well is that 59% of high net worth individuals have actually one wealth manager. So it gets a little bit harder for wealth managers to actually get noticed. And there's a small percentage of millennials who have 2 or 3 wealth managers, and we can explain that because they're willing to have that electronic relationship with their wealth manager. So this enables them to have that. And what we've also found, according to Forrester, for example, the awareness and the consideration stages in the traditional customer journey is tourniqueted today because 65% of millennials open an investment account within 1 week of actually thinking about opening that account, and 17% of baby boomers do. So it is quite challenging for wealth managers and wealth firms to actually get recognized by those potential clients.
Great. All right, the next question is more along the trust gap right now as we move towards a digital environment. So high net worth wealth individuals have been with their wealth manager on average for about 5+ years. Building up trust with a financial advisor can really take a while, and once you have that trust, it's very hard for that high net worth individual to leave. So I guess my question for Cameron and Michael is really, how does a wealth manager develop trust in this digital world?
Happy to take that, sure. So actually, this is my favorite of all the topics within sort of digital advice, because I think that when you think about digital advice and technology and wealth management, I think the big thing that's going to change, and maybe less sort of obvious, is that in traditional wealth management, that trust has been built up. There's a huge trust gap, right? A prospect comes to an advisor, maybe they were referred in, and it's your job kind of sitting across the table from them to build that trust, and that might be 1 meeting, that might be 10 meetings, but there's a lot of sort of energy that goes into it. When push comes to shove, though, on average, the way the industry has sort of gotten consumers to trust them is just a lot of time and energy, a lot of conversations, and there's this leap of faith that has to happen, because the consumer can't really experience the service until they experience the service, right? And I think what's happened now with digital advice, and you look at least the way we approach it, is we have account aggregation at the front end. Within 5 minutes, we're providing all of the investment advice, savings advice, asset allocation advice, all of that is being provided actually for free to the consumer. And they might look at it, and they might digest it and say, okay, that's all good and well, and then we follow up with an email every week or every month for months on end, right? And so what you're effectively doing is engaging the consumer in a digital way, and you're making the gap, that leap of faith that the consumer has to make, it's actually smaller now. And I think it'll continue to shrink, not just with robo-advisors, but I think just more broadly, in terms of if you can provide more advice, if you can create a digital experience that gives the customer the feel of what the wealth management experience will be like and gives them a lot of that value up front, I think that's going to actually make it easier and better for advisors in terms of the way they interact with consumers. And I think that's a big change, or how I think the industry is going to operate going forward.
We have an expression that clients don't really care what you know until they know that you care. So building trust is a big part of that, and asking good questions. I think, but there are also other items that you talk about that are critical that apply not only in the old school way of doing business, but in the new school digital way. And that is basically the 3 or 4 simple things of, doing what you say you're going to do, being reliable, showing up on time, saying thank you. And those are really important things. And those transition to digital as well. So if you have a digital strategy of some kind, you need to make sure it's consistent, it's fresh, it's reliable, it's applicable, it makes sense to them, and that there is some sort of education element to it as well, so that they do understand that you know what you're doing.
I agree with everything Cameron and Michael have said. I'll just build on it. because there was an interesting survey. Edelman surveys, trust in various industries, and financial services came out at the bottom with a score of 51. Technology came out at the top of all industries, with a score of 75 or so. And pharmaceuticals and stuff were in between. So people don't trust financial services by and large, but they do trust technology. And it's not that there's just something inherently better about technology, but it's the transparency that it brings. It's the information that it delivers, the same things that you guys are talking about, and it shows up in those numbers. And I think we have the opportunity to be able to use it to help people trust financial services more.
And just to build on that point with trust, and personal recommendations is 4 times more effective in getting new clients, right? And so if you can use, wealth managers can use their current clients' social networks and infuse that with a content that is sharing their authentic voice, and use the social networks and amplify that using social selling tools and share their content with their current network, that's a great way of actually building awareness and building that trust with the new clients through your current clientele. And before I move on, I also want to let you guys know that you should be sharing this information on LinkedIn or Twitter during the session. And you can see all our Twitter signs up there, as well as the hashtag, which is WM Customer Journey. So please go ahead and share while you're here.
Great. Thanks, everyone. And then lastly, I wanted to wrap up the awareness area of the customer journey with a question for everybody. Really, high net worth wealth individuals plan to change their wealth advisor. There's a significant population that does want to change their advisor. Do you guys see this trend happening? And also, what do you think are the reasons behind it?
Well, we can maybe approach that just from the data and the research. And there was a substantial number of respondents that were looking to change their wealth advisor. Again, that differentiated across the spectrum. You look at millennials, and almost a third of those were looking for a change to their wealth advisor, which is a really high number, versus the Gen X or the 70 plus that were more around 10 or 11%, which is probably pretty stable. Why were they looking to do that? Number one reason was pretty obvious: returns, right? But then came other factors, right? And it's interesting when we looked at what were those factors that, say, millennials were concerned with versus others. Everybody had the table stakes of financial planning and planning for retirement, perhaps. Millennials far more interested in additional services being offered, right? So it could be robo-advising, but it also could be things like tax planning, it could be estate planning, it could be insurance, access to capital, and access to credit. All of those things were very important to that segment that weren't necessarily as important to others. So if the message that we took out of that is, if you're not offering those services, or if you are offering them but they aren't readily evident to the millennials anyway, you really need to put those front and center, because those things came out very clearly as being important and one of the factors that would get them to look to change their advisor.
I think that trend's definitely going to continue, and I really hope it does. The reality is that there's probably a couple of reasons, returns and the things you mentioned for sure. I think there's still a lot of money in sort of the old system. I think a lot of millennials come into some money perhaps, and they're working with their father's advisor, and it's an old system that's really not understanding what they're interested in, not only because they're young, but more importantly because they're just selling products still. And I think that millennials see through all that. So they get easily turned off. As soon as they have some means to look out for some other opportunities, they pretty much run from that model. And I think the other thing is as they develop their own wealth, they want to work with somebody who really understands and can serve those issues beyond, as you mentioned, estate planning. The first things is, do I need a will, and what should be in that? And those kind of elements go way beyond that old system. So I think and I hope it continues.
Well, good news for you is that 38% of millennials are actually looking to find a new wealth manager within the next 12 months. So that's really good news for you. We're also seeing that some of the reasons why they want to change is because of higher quality of service, better performance. We're also seeing just the higher personal engagement, in fact, is one of the reasons why they want to change, as well as just general openness to trying new things, right? So those are some of the reasons that we've seen from our study why, especially millennials, but high net worth individuals in general, 1/5 of them are also looking to change their wealth advisor in the next 12 months. So you have a lot of business coming your way.
All right, I'd like to move to the next area of the customer journey, which is the consideration and selection phase. And so one of the key findings from the study was that personal recommendations still seem to be the most valuable way for prospects to engage and find a wealth advisor or wealth manager. So I guess my question for the team would be, are there any ways wealth management firms can help amplify this?
We see referrals at Betterment being our #1 channel for customer acquisition, which I think surprises some people, but it always has been. As the company has grown, it's continued to accelerate, and I think that word of mouth is what's powering our accelerating growth. We do what we can to encourage it. Obviously, we have a great referral program, but a lot of the referrals don't even come through that program. It's just people telling folks about us, and I think that is something that you see in the data that millennials are likely to trust recommendations of their friends. They may be doing it on social, but it's also true that retirees and pre-retirees and everyone who's thinking about changing wealth managers is basing that on recommendations, maybe not through the same channels as others, but you always go to that person that you trust in your life and ask them about what you should be doing with your money.
I mean, the only thing I'd build on that is, look, when sort of word of mouth and referrals has been powerful forever, will be powerful forever, right? So the question is sort of what's new and what's different here. I think obviously the channels for referrals are changing with social media and LinkedIn and other platforms that are out there. But I think as we've looked at it, and what a lot of wealth managers are saying to us is invest in the platform, meaning invest in the service and the experience that you're delivering to customers, so there's something to refer about. Wealth management has always been a kind of a tricky thing to refer on. You can get a question, do you know a guy? And you can say, yeah, I have a guy and he's good. But a lot of consumers don't really understand what they're getting. They understand the service, but the actual nuts and bolts of wealth management have been pretty complicated. I think one of the things that's changing, partially with robo-advisors and partially elsewhere, is just the experience of looking at your investments holistically and being able to see that, being able to see graphs that show you where you'll be in the future, and being able to sort of tangibly look at your goals and bucketing, visually look at these things, engage with your money in a mobile app. Those tangible proof points that remind you of other things you like Uber and other things, are easier for consumers to reference, to say, hey, I really like their mobile app. I really like being able to sort of see where I am and saving for college. I can do that in 10 seconds. So I think part of the virality that can happen and amplifying that is really investing in that, in those product experience features that consumers are looking for now.
Yeah, the only thing I think I would add to that would be, the personal recommendations are given. Some suggestions, right? Make sure, not a plug for LinkedIn, but make sure your LinkedIn profile is out there. We found a high percentage of folks that even after that personal recommendation, what do they go out and do? They're checking the LinkedIn profile and they're seeing what that advisor has out there. Make sure that's right. They're also checking Facebook. They're also looking at Twitter. So it's not simply one. I would also be careful about what you say, right? They're looking at blogs, they're checking history. They want to see what you have out there for a profile. And that, interestingly enough, yes, the millennials were higher on that maybe than some others, but actually the 70-plus-year-olds were very high on that as well. And in fact, almost at an equal footing with that when we split it by assets under management. Those with 10 million or more of investable assets were almost at the same level of use of social media and research as the millennials were on the other end. So if you're looking for the very high net worth individual or even the very high net worth millennial, make sure that social profile is up to date.
Great. Thank you so much. Just moving on, another finding from the study was that in-person meetings are still important despite the trend towards digital. So when considering a wealth manager, high net worth wealth individuals base their satisfaction level on the in-person meetings that they have with the wealth manager. So my question for, I guess, both sides of the table, the robo-advisors and as well as the wealth advisors, would be what unique strengths do advisors have that digital will struggle to replace, as well as how can digital and social engagement amplify the role of these advisors, of these in-person meetings?
Well, since I'm definitely of the experience of sitting down toe-to-toe with the clients and talking with them, it's unique. There's no doubt about having that one-on-one experience with a client and looking them in the eye, although we work with some clients that are out of town and might do that through telephone and other ways. But the ability to meet one-on-one is important. I think it's more important in times of, I was going to say crisis, but times of importance for the client. So maybe it's crisis because there's a market crash or something like that. But more importantly, there's a personal issue. It doesn't have to be a crisis per se, but a personal concern. And to be able to address that one-on-one with the client, and of course have the backstory of all the things that are important to that client, definitely gives somebody who can do one-on-one a unique ability. But I don't think that means that you can't do it digitally or you can't do it in other ways. It just gives you, that advantage in that way.
Yeah, I would agree that good times to engage with clients are around life events and things like this. We have built Betterment around goals and financial planning and helping people reach their goals. And if we see them off track, that's an opportunity for us to reach out, and we will. We partner with our advisors and we give them that same information. And we have internal advisors who clients can call when they have questions that go beyond whatever they see in the software. So I think there's a common misconception that it's about technology versus humans. And I do everything I can to dispel that notion. It never has been like that. Every advisor uses email and Excel and a whole host of software programs to better manage their practice. We provide the best technology to manage their clients' portfolios and financial planning, and that just makes it more efficient for the advisors to have these kinds of important conversations that they should be having with their clients.
And the one thing I'd add is just, the big thing that separates wealth management from maybe other industries when you look at technology changing it is that there's an unexpected sort of probabilistic aspect to wealth management. So, a lot of people have talked about digital advice and said, look, it's kind of like, Expedia and online travel agents came in and, there's sort of no more travel agents anymore. But it's a very different sort of product experience, right? You sort of transact and then it's done. Very rarely is there a problem with actually booking a flight or a hotel, and that's kind of it, right? If you sort of look at the other end of the spectrum, life happens. Markets go down. People have kids, issues need to come up. And so, specifically to the question of, where are humans kind of advantaged, I think humans are really advantaged in dealing with the unexpected. And as an advisor before I came to BlackRock and Future Advisor, it's those, rarely is it the stuff you've planned for and the goals that the client wants to talk about. It's the stuff you didn't plan for. It's the things that happen. And this unexpected aspect of sort of just life happening and the markets moving and goals changing, and humans are great at that. We sort of adapt on the fly and we react with people. And so you can use the technology to really kind of automate and make better and make more precise the things that are to be planned and automated, and the unexpected is really where the human advisor has a lot of value.
I just want to throw one more thought in that I hadn't thought about earlier, and that is that there is a segment of people, millennials and otherwise, that just either aren't that interested in the topic. So if I'm going on a trip, and you mentioned the travel agency thing is a great example, there are people most people are passionate about where they're traveling to, and they're willing to make the investment. They're willing to spend, they want to spend, not willing, they want to spend time, especially if they're taking their family or somebody else with them. They want it to be a wonderful experience. And that's a main reason why, and there's so many great resources digitally to do so. There are great resources as well on the investment side, but there's a lot of people that either A, just aren't interested in it at all, or just too busy. and they need to delegate. And they're happy to offload that responsibility to somebody, either in a fast digital way, or maybe their situation's so complex they feel that they need somebody who really understands deeper. So I think that both the human and the digital platforms will benefit from that, either just not having enough time or the willingness to delegate.
Yeah, and we do a lot of research across sort of all spectrums of the financial services marketplace, and we take this question on in many different ways. And what we have found consistently is that human touch, when there's a significant event, somebody wants to talk to somebody, right? Whether it's you hear about high frequency trading in the institutional space and electronic trading and all that. When markets turn or somebody's making a big trade, the first thing they want to do is pick up the phone and talk to somebody. Even though all of the technology is there to make that trade, they're picking up the phone. So the sales trader in that case is still very significant, and it's not going anywhere for a long time. I think the same thing holds true in the wealth management space. When there's a significant event, they're going to pick up the phone. They're going to want to call somebody and have that, if nothing else, that second opinion for what they're getting online. Wait a minute, before I do this, let me talk to somebody. I want to get a trusted opinion, make sure I'm doing the right thing. So I think that personal relationship is going to stay for a long time. Big changes on the technology side, but I think that's hugely significant to have that personal relationship.
Great. Thank you all for your very thorough answers. I'd like to move us on to the onboarding and action planning stage of the customer journey. And that is really when, with regards to business models, once a new wealth manager relationship is established, it is now time to decide the path forward. And so I'd really like for everyone here to really ask a question about, what type of business model do you think will exist 3 years from now versus today?
I think maybe it was Michael, somebody on the panel said it best, that you're always onboarding clients. That onboarding process never ends. We think about engagement as being so important. As our service evolves, as the space evolves, we have so much education to do because the products are evolving faster and faster. It's not as though technology exists and there it is and it's great and it's changing every day. And I think in the future, when we look ahead 3 or 5 years, far more people are going to be using robo-advisory services. It will be the way most people manage their money, and in time it'll be the way all people manage their money, because it's just obviously better than other things you can do with your money. It's better than, say, a target date fund, which is a bucket of money for 10 million people. I mean, we're talking about an account that's personalized to you, to your own goals, to your own tax situation, optimized for everything that you want to do in life. Of course you want that. It's just better. And so we see that accelerating, and I think advisors are adapting to that and changing the way that they advise clients, changing the things that they do, specializing more in particular advice that they can give outside of the asset allocation or account management piece.
Oh, somebody has to be controversial. So you asked for 3 years out, right? So I agree with a lot of what you're saying, but I think that's 10 years out versus 3 years out for different categories. So in this case, we're talking about the very high net worth. I think that probably will move slower in that direction than say the mass affluent, which I think can move a lot faster in that direction. There's a lot of reasons for that. But I don't see that high net worth individual with $5 or $10 million to invest, moving everything over and going completely automated and saying, okay, that's it. I'm just going to leave it there and let technology manage that for me. I just think 3 years is too close a time frame for that.
I'll go one step further and say that I don't think that everybody will ever go that way. I absolutely agree that on the mass affluent side, it's actually a service that's worth doing it. It's probably an advantage for the mass affluent to have these tools and helpful to them to reach, because we all know that a lot of people just don't pay enough attention to their financial services, or their financial situation, and it's providing a great service. But having a background as a CPA, I'll use the example of sort of, say, TurboTax. So remember when TurboTax came out, a lot of CPAs thought it'd be the end of the tax business, but that's really not the case. The reality is that not only are high net worth, maybe it's greater than $1 million of investable assets, but surely high net worth clients definitely want more than an automated solution. And they want somebody who knows how to work that automated solution, perhaps. But they definitely want people that are looking at the bigger picture, thinking about things. And then there's also a bit of just, for right or for wrong, a bit of a panache. I mean, you have clients that still, I'm shocked to see people still poo-poo mutual funds. Mutual funds are the greatest thing in the world, or ETFs are the greatest thing in the world for people to invest in. But there are some high net worth people that view that still as sort of themselves above that. So I think you'll also have that issue of some people just not accepting the fact that that is acceptable to them.
I love the TurboTax analogy because I feel the same way in terms of how the industry would evolve. But if you sort of sub-segment what happened with tax prep, I can go do my taxes by hand basically for free. I can go pay TurboTax, I don't know, $50, whatever it costs now, right? I can go to H&R Block or Jackson Hewitt, which is sort of like a sort of professional in an office location, but not, and then I can go to a private CPA. But what's interesting is even the private CPA, he or she is not doing it by hand. They're using enterprise software. Like you turn the screen and they've got their own sort of robo-tax thing that is sort of custom built for them. And the way we look at it is, we think that the wealth management industry is going to evolve in much the same way. We're getting a lot more consumer choice. There is a market who's going to want to have it entirely kind of digitally managed. It's the do-it-yourself, use TurboTax segment. And by the way, it'll probably correlate more with younger and lower net worth, but just like you see, Warren Buffett's famous for like driving an Oldsmobile forever or whatever, right? Like there's high net worth investors who want that kind of low-cost service. There will be people in that bucket, and there will be lots of people along the way. I think the point is, if you're a CPA still like with a ledger book trying to do high net worth kind of accounting, that's not going to work in the future, right? And so the industry is rapidly evolving. Whether you're serving the high net worth or you're serving the mass affluent, it's just going to be there will be a digitization of you mentioned onboarding, kind of the operational aspects, which are necessarily less value added to the client. There will be a digitization of some of the aspects of the wealth management experience, and that's a good thing. I think that'll happen across the spectrum.
It's already happening. There's so much money being invested in FinTech right now, and all the firms are adopting, whether it's just DocuSign or rebalancing software. It's all over the aggregation. It's all throughout the wealth management industry already.
And I think one thing we saw from the study as well is that there's going to be, a lot of wealth managers aren't going to be able to have the capabilities to build their own services, right? So there's going to be a lot of open API, right, where they can have cloud-based, when they can have different APIs to bring in the best-in-class fintechs to provide the best services for their clients as well. So I think that's going to see a big difference coming up probably in the next 3 years, 3 to 5 years. We're going to see that happening as well.
Great. So we've talked a little bit about how the wealth advisory models are going to change over the next, over the near term and also the long term. So I'd like to dig a little bit deeper and actually ask more specifically, how do you think the pricing model will change over the next few years, given that there's a lot of media attention on that these days and it's becoming increasingly scrutinized in the news?
Well, I think that providing advice is expensive because people who are qualified to provide that advice are expensive. I mean, you're talking about people who can, are great at math and are great at communicating and are great at empathy and understanding. And you're looking at really like a generalist, and that drives up the price. And so an hour with that person is an expensive hour. That's why it costs what it does. I think our thought is that over time, some of that cost is driven down because the technology can do more of it, and that allows advisors to better scale their practices and to serve more clients more efficiently because they're doing less of the actual management, rebalancing, and back office tasks, and they're able to spend more time with clients, and that helps to drive the cost down somewhat. but it's still expensive time.
So I think this is the great worry of the wealth management industry, what's going to happen to pricing. So if we're being honest, average pricing is coming down. It just is. But I think but again, I come back to the kind of segmentation of consumer choice. So, look, you can buy a Rolls Royce for, I don't know, whatever it costs, $300,000. You can buy a Kia for $14,000. Both of them are cars. They both sort of get where you go. So the question is, well, what does that mean in a world in which there's that sort of stratification? I think that's the world in which we're going to. We've been in a world where there's kind of only one car and it was black and it cost this amount of money. That was the wealth management industry for a long period of time. We're now getting to much more stratification within that. And for that do-it-yourself sort of TurboTax buyer, the price will be pretty low. I think for the buyer who wants a more personal, high net worth, high touch service, there's the cost of delivering advice is high. It'll come down as you can make it more efficient. But one, I think we're going to see more stratification. And two, and my great hope and the great opportunity for a lot of firms that are looking at this space is, the market for providing advice at a low price basically was non-existent. Right? There was no kind of Kia Hyundai market 30, 40 years ago, and they kind of came in and created that market. I think technology is enabling that to happen. As we look at some of the partnerships we've announced with large banks and wealth managers in the United States, they're using this to go after that segment of the book that they couldn't profitably serve. Those customers below a certain dollar amount, they couldn't serve them with the advice model that they have today. And so they want to then deliver a more technology-forward solution, and it'll be at a lower price, and that's fine. And there'll be a totally technology solution and kind of everything in between. But the average is going to come down. But I think it's more because we're going to get more people into financial advice, and there's going to be different price points for different services.
I'll focus on just the high net worth side of things rather than the broader spectrum. I think that from a structural standpoint, you can see it coming. The transactional nature of market structure in that wealth manager space is going away. It's coming, like you say, increased scrutiny, and I think that scrutiny is probably there in many cases for good reason. Things will move away from that transactional nature, and I think in time we're going to see everything to an asset basis model. I don't think there's any getting away from that, either from a societal perspective or from a regulatory perspective. I think that's coming. Nothing to add.
All right, moving on to the next customer journey point, which is network development. So the research study indicated that a lot of high net worth wealth individuals, as well as millennials, found that the ability to connect, network, and share information with their peers was highly rated and highly coveted in their wealth management experience. So my question to the panel is really, do you guys feel like this should become part of the wealth of management advisory experience? Should the wealth manager be giving advice on, dating, social activities, other networking events even?
This is going to be good. I'm staying away from that side, but I will start just from the pure research side. And this is one of the things, quite honestly, that surprised us, certainly surprised me, is how important that sort of the networking was to the high net worth individuals. And that was, again, across the spectrum. Folks at 70 above were as equally interested in networking as millennials were. And it may be on a different sort. They may be sitting in the back room at the country club after a round of golf and chatting about investment advisors or investment opportunities versus somebody else that might be doing it in a much more electronic or social way. But it was very highly valued across the spectrum in high net worth. Now, whether the wealth management sort of industry should be the facilitator of that, and how far that should it go down to to dating services and the rest, that might be a little far. But I think that what we have seen is the wealth manager should certainly be engaging and trying to do as much as they can to bring their clients together, like-minded clients. And if they can put themselves in the middle of that network, it has to be valuable to them and valuable to their account retention strategy.
Yeah, and that's what we saw, in the research study is that network development, bringing that, what we saw like at the country club to online communities is really important, right? And it's actually because we said earlier, personal recommendations is 4 times more effective. So bringing your community together, the wealth manager is fostering that type of community. And it's a goodwill, right? And then it's more likely that your current clients will also recommend your wealth manager as well, right? So having that online aspect as well as having it in person is really important. But I think also moving forward is really integrating the wealth manager, really integrating themselves into the lives of their customers, right? Really being a part of their life, whether it is finding a new job and helping them do that and bringing the right people to that, or if they want to start a new business and how do you help your client learn about entrepreneurship, right? So I mean, and also dating, yes, that could also happen if you have like happy hours or you have skydiving events. So there's a lot of different things you can do to really like integrate yourself into your client's life and make them more feel like they need you, they want to have you, and you have less likelihood of losing them as opposed to just being on the peripheral of their life.
I need to get my wealth manager to do skydiving.
Just some ideas.
Maybe I'm sticking around. I gotta tell you, that's pretty good.
Some ideas for you.
Thank you guys for answering that. Just moving to the last area of the customer journey, which is keeping the relationship alive and really dealing with the retaining that customer after you've managed to acquire and after you've managed to nurture and really help financially plan that relationship. So one of the key study findings was that during market volatility, millennials do want to receive and hear information from their wealth managers. So my question to the panel is really, does your communication frequency and tools change during market volatility times and portfolio moving events versus a stable market environment? And what type of content are you sharing?
We've always tested around this idea of how do you message during volatile times? How do you help improve customer behavior? It's part of the reason I started Betterment was this idea of we're better off when we don't get in our own way, when we can overcome the behavioral biases that we have and we don't respond to market moves and so on. And we've noticed that we're able to significantly shift customer behaviors. We do things like, we do many things to do it. We do in-app messaging. Before you make a transaction, we'll show you what are the likely taxes of that transaction, which no one else shows you. When people see that, 75% of customers decide not to go through with the transaction. So it has a real impact on customer behavior. It's kind of an incredible impact. And we see that dampens people's activity during market moves, which is good for the client because they don't incur the tax, but it's also good for them because they don't incur that behavior gap of trying to market time that's such a drag on investor returns.
We've similarly focused a lot on that ongoing engagement. I think that's one area where the wealth management industry has lagged, right? The industry is focused on sort of asset gathering, not asset delighting. And so, a couple of the things that we've done is, when we look at market volatility, we'll send personalized emails before people wake up in the morning. Our sort of rule is if there's going to be a market-related story on the front page of the USA Today or the Wall Street Journal, there always is in the Journal, but USA Today would be our benchmark, you should get a personalized email before you wake up. Right? And when we have the information, it's not just the markets are down, but because you were diversified and half your portfolio was in fixed income, your returns were this versus something else. That goes a long way to doing two things. One is, when we started doing that, the call volumes, the inbound call volume, the sort of that came down dramatically, right? The sort of panicked activity, the sort of getting in your own way stuff, came down. But the second thing is, again, it comes to my advisor, human assisted, digital only, whatever it is, but my advisor is watching out for me, is engaging with me, right? And for a lot of clients, sometimes, especially if you're in the mass affluent segment, you're wondering kind of what is your advisor doing for you on a daily basis, right? Whenever we rebalance or earn dividends, right, I get an email, my watch vibrates, right? I know that something's happened in my portfolio, and it's an odd thing, like why dividends? Like I just received dividends, why would I want to know that? But you're delivering value to your consumer, and the consumer then gets that kind of subtle reminder that occurs throughout the time period. And so whether it's volatile time periods or just normal time periods, email communications, notifications are our way of saying, I'm monitoring your portfolio, I'm working on your behalf, and that's a very powerful thing to deliver to clients. And again, that's part of this whole referral thing is what clients can then say to their friends. I don't just like my advisor, it's he or she or this service is really helping me on an ongoing basis, and I do these subtle things that I really like.
The thing that I'd add is just I've been surprised by how a handful of my clients would say, don't send me too much communication when the markets are in turmoil. It sort of makes me nervous. It makes me almost think that I should be doing something because we've spent so much time up front sort of educating that it's important to stay the course and not to get too panicked in that environment. The majority of our clients, of course, appreciate the communication, but I just thought I'd note that there are some clients that actually don't want to be communicated too much because they think that something might be wrong.
Look, you guys, you're all going to get the research. You'll find this is one of the sets of questions that we asked was how often do you want to be communicated with on a regular basis, and how often do you want to be communicated with in times of sort of market turmoil. And the answers didn't change very much. And folks don't want to be communicated with on a daily basis or a weekly basis, and maybe a monthly basis, maybe a quarterly basis, but they don't want repeated, interaction from their wealth manager. And I think part of it is because they went there and it was the stay the course model. And that makes me too nervous, like you say, getting things like that. Take a look through the research, though, as well, and see how they want to be communicated with, right? So email's the most common method. That was true across all, although I would tell you that Millennials was the lowest in terms of emails, and 70 pluses was the highest in terms of emails and how they want to be communicated with. And look over at Millennials, and it's much more growing. The categories are much higher in growth of things like I want to be communicated with in a mobile app. I want to be communicated with through social media, where that necessarily wasn't the case with some of the other categories. So when you get that, take a look. It was a pretty good set, and I think it'll tell you a lot about how they want to be communicated with and what the frequency of that is.
Just to add to that point, Millennials, surprisingly, we found during market volatility, they actually do want to be communicated with from their wealth manager, only because even though they do read the news, they're not unable to interpret that news and the impact that it's actually going to have on their portfolio. So as opposed to Generation X, who, like these guys were saying, don't necessarily want to be communicated as much, right? Because they're able to understand the news, interpret it, and understand the impact of it on their portfolio.
The interesting thing I just build on that too is, we're speaking in generalities, Millennials, Gen X, something, but coming from the advisor standpoint, clients are unique. Some Gen Xers want this, and and I think that's one of the great things around what technology can do to the wealth management industry. You can customize it. I can say I want emails daily, weekly, monthly. I don't want the notifications. I do want the notifications. We're now used to that in terms of sort of, at least at my own, just sort of which apps I allow to notify me, which I don't in the online banking world. Do I want my watch to vibrate? Do I not? And you're used to that across your technology life, right? But the wealth management industry has kind of lagged, and it's it's tough on an advisor, especially if you're serving a more mass affluent client and you have 300, 400, 500 type clients, right, to an individual advisor. How do you keep all of that straight? I think this is a perfect example where, when the industry, we're caught up in sort of humans versus digital, and there's too much technology. But, this is about delighting the customer and giving them the experience that they want. And technology can easily help mass customize the way you communicate with advisors. You just have to, with consumers, you just have to invest in that technology.
Great. Well, thank you all for answering again very thoroughly and providing such great answers. In the interest of time, I did want to open up the panel to any audience questions while we have a few minutes left. Would anyone like to ask a question?
Great. Quick question on seasonality. Obviously, digital media has created a situation where you're always on, and it's kind of denuded the impact of having any kind of specific efforts. Do you still find that the fourth quarter and first quarter concentration still hold true, or are there new opportunities in any other quarters or specific timings of the year that still have some value for advertising for financial advisors?
We see it's a little bit hard to tell because every month is faster than the last for us. August was our fastest growing month of all time. Summer, however, is generally slower than the rest of the year, and first quarter through tax time is probably our biggest season, because that's when everyone's thinking about their money, everyone's thinking about IRAs and rollovers and contributions and maybe a new 401k plan or whatever it is. So there's just lots of money cues that time of year that get people to make changes and reorganize. And I think technology doesn't have anything to do with that. I think no matter where you are, those are just signals that are out in the market.
Thank you, Manica, and thank you, LinkedIn, for hosting the panel. My question is, a big part of people's decisions in terms of working with advisor approach at the retirement phase, where they're not sure what to do with their 401k, roll it over, et cetera. I wonder if you could speak to the notion of how robos will play in that space. Do you see 401k providers adding robo capabilities? Do you feel as though robos will get into the 401k market? What are your thoughts on that? Thank you.
I'll go after, but since you're in the market, and then I'll give another perspective.
We launched, Betterment launched a robo 401k, if you will, earlier this year. And I think what's really exciting about it is that for the first time, we've made available personalized advice for every participant in a 401k on a mass scale. And nobody else does this. There will be others, I am sure. It's just the way that things should be. But you think about combining that personalized advice for every participant with record keeping and the whole plan management all in one package for an extremely low cost. It's just, I mean, that service has been selling almost too well. Like, we can't keep up with the demand for it. We're having to put plans on hold to make sure that we can continue to deliver, amazing service to everyone who's on the platform. We've seen plan sponsors really excited by the idea that everyone gets it. I mean, there has been advice maybe for an advisor will come to your office and 10% of the company will show up. Or there's sometimes opt-in advice that you have to pay extra for. For us, almost all of our plans are default, everyone contributing, everyone is default into the plans. 6% annual contribution, I think, is the default for most of them. And everyone has this plan about what their retirement goal is. Are they on track to meet that goal? How much should they be saving, not just in the 401k, but in the IRA, in the taxable account? And we coordinate across those. So we'll put the right assets into each. Nobody does that. I mean, everyone should have this kind of technology, and soon I think everyone will.
I'll take a slightly different angle on it too, which is, so as we found in our digital engagement with consumers, retirement is definitely the first goal. So when we think about it from a goal planning perspective, consumers, the first goal that they think about is retirement. And so then the question really is, how do I get there? I think there's a myth that much of robo-advice is, here's $5,000 from a 24-year-old, and that's kind of the whole industry. Our average client, our median client is 42 years old, and they're going to give us, on average, we're managing 2.2 accounts per client. So there's typically a taxable account, there's typically an IRA, and that IRA was a rollover from a 401k, right? So when you get past a sort of early in your career perspective, I think we all experience this, is this fragmentation of accounts. We change jobs a lot more than we used to as a society, and so focusing on the holistic picture, in particular, one of the biggest challenges is those old 401k accounts and what to do with them. I agree with John, we're going to see more automation within the 401k. We've come at it from the perspective of, look, if I'm serving a consumer across the variety of accounts, we manage multiple accounts, we do the asset allocation within those accounts, but the biggest challenge we've seen with consumers is just I've got multiple old 401ks in some context, and what do I do with them? How do I sort of consolidate them and manage them?
I think the real challenge is going to be on what's called deaccumulation. We've all been forced to save. We've read it, every magazine, everybody says we have to save. There's great resources which we need to help people save better. But I think the idea, and people know how to save, maybe not well, but they know how to save. I think the real challenge is going to be, how do I deaccumulate? How do I convert that into income for myself? And how much can I afford? What if I have longevity in my family? Will I be able to have enough money to make it that way? How will Social Security, if it's around, integrate into that income stream? And then what if inflation is high or medical expenses are here? And I think that's where there's still a lot of development needed to be done. Fortunately, the millennials have some time to get there, and I'm sure you guys will figure it out. But I think in the meantime, that's going to be a harder challenge.
I have a question. Yeah. My name is David Ross. I work for a fund services company now. My career has been on marketing, both the sell and buy side, but now I'm marketing what I call the back side, so middle office. So the question is for both wealth advisors and for the robo-advisors is, on its effect for the customer journey, how are the operations affecting what you can provide in terms of product development, the seamlessness of this journey, innovation? Does that hold you back? Is that help? What's your experience on moving this customer journey forward from a middle and back office perspective?
It's a really interesting question. I love it because it's not one that I often hear, but it's so core to what we do. This the better processing on the back end. I mean, Betterment is an investment advisor, and that is our customer, facing entity. We also manage a custodian and a record keeper in our broker dealer on the back end. There's a ton of investment in that technology and people who are experts like you in managing operations of a custodian and record keeper. We think that is our core competitive advantage in the long run, that we are a more efficient investment management shop because we have driven the costs down there. We could have gone and we could have built on top of an existing legacy custodian. We would have had to pay their account opening costs. Everything is like a little more paper-based. We've automated all that stuff. So that has driven the cost to serve down so that we can make money offering a product for less than what anyone else charges.
And we've taken a slightly different tack, but still the same concept of heavily investing in the operational side. So we don't have our own custodial layer because we work with bank partners or broker dealers, but the amount of effort we put into, just like give one example, ACAT transfers and the transfer of assets is enormous. The amount of automation and monitoring, I mean, that's a kind of a clunky process for the consumer. At one point in the ACAT process, your money literally seems to disappear, right? It's not at the sending custodian and it's not at the receiving custodian. You literally have no money. That's pretty scary for a client who's coming across, right? So, being able to show that in flight and being able to communicate in an automated manner and then being able to follow up on it, I mean, we found that to be a huge drop-off point in the wealth management industry and actually a huge differentiator for us in terms of how we engage with clients there. So a lot of effort has gone into building that automation. It does actually pay off some results for the client in those specific examples. But it's really going to pay off in terms of the way advisors and advisory firms can scale their practice, and they can spend less time chasing down, sort of custodial firms or DocuSign and its ability to do that. It's just it's a way that's going to really allow this to operationally scale for the wealth management firms that we're partnering with.
Well, thank you, everyone. Oh, Mike, did you have a question?
I can end with somewhat of a provocative question for the panel, but I'm from LinkedIn.
Let's go.
I gotta go.
Yeah. Nothing like the last audience question being one to spark some conversation, right? But curious from the panel's perspective, and I can actually recuse Jonathan if he does not want to answer, but I think a lot of people, as these platforms scaled, anticipated a lot more M&A than has occurred. And of course, Cameron, you guys exited and now a subsidiary of BlackRock. So I'm curious from the panel's perspective if you anticipate a wave of consolidation and M&A in the next couple of years.
I'll take it from an independent perspective. I don't have an axe to grind or a company to sell. And we, as part of what we do in my practice and at Greenwich Associates, we look across all of FinTech. So I'll take it from a broader FinTech experience. And clearly there'll be, there's so many startups, there's so many providers in this space. There's got to be a consolidation, and there's got to be a level of there will be some acquisition, there'll be some consolidation, there'll be a whole bunch of folks that just don't make it, right? And we see that across sort of all new FinTech development, and I don't think this particular space will be any different than that. So there's a lot of hype around it right now. It's in the news, it's in the newspapers. I think that will sort of die down, I think, a little bit, and the cream will rise to the top, and others, will not make it. That doesn't mean that they don't benefit the industry as a whole. I think, the industry and society is better off for all of those folks that actually, tried and didn't make it, and I'm sure they will turn around and try something new. But I think clearly, we see that as a process that will lead to consolidation and acquisition, and then unfortunately some fall off.
I mean, I would say I think a lot of people look at the M&A or acquisition in the industry from the perspective of, look at all these startups. Are they really profitable business models? Is that going to make sense? Maybe they're just trying to sell themselves. But I look at it from the perspective of, look at the buyers and look at the interest that's coming. It's a vote by the established financial institutions, wealth managers, banks, and others, in financial technology, and the importance of that for the business model going forward. And so I think a lot of the firms that are making acquisitions are really just doing a kind of build versus buy versus rent decision. And from a Future Advisor perspective, our calculus was a lot of people are going to want to rent this kind of technology. I live in the Bay Area. You look at the acquisition history. A lot of them don't work, right? And the financial services industry is even less experienced at buying customer-facing applications than the rest of the technology industry is. So, there are many who are going to make the calculus. I have to own it. I have to buy it, and they make that choice, and that's that'll continue to happen. But what we're really seeing is just a recognition by the incumbent players that they have to change the way that they're doing their business model, and you will continue to see M&A for those who decide that they have to own it. But what I think you'll continue to, you'll see there will be probably some ebb and flow here. But what you won't see is a diminution in the investment in these sort of digital client experiences, because that's what consumers are demanding. That's what wealth managers will do. Some will buy, some will build, and hopefully many will rent from us.
Well, thank you everyone for joining us this morning. We really appreciate it, especially staying over a few minutes. Please take some time to check out the gallery downstairs, and don't forget to review our research study. Thank you so much, everyone. Thank you, panel.